This morning, like every morning, I watch the beginning of Squawk on the Street with Jim Cramer and David Faber and Carl Quintanilla, and because I respect these guys. Jim makes $5 million a year, and both Carl and David make in excess of $3 million a year. So they get paid better than I do to share their knowledge of the stock markets. And we know that Jim and Carl and David have been in it a while, so I respect them. And Jim made a statement today that really caught me off guard, and I wanted to go into it. He was basically touting the successful earnings reports from both Ford and General Motors, and he started the statement by saying that they were both a part of his charitable remainder trust, and Ford was one of the largest holdings in his trust, and how well they had done. And then he hit me. He hit me in the nose. He basically said, Mary is doing such a great job. Mary's the CEO of GM. He said that she raised or generated $5 billion of free cash flow this year, and based on their market cap, 10 years of that, and she could buy all the stock back from the stockholders and have a very profitable company to own by themselves. And I thought, is he shitting me? Does he not know that company's on a death march? Does he not know that that's 50% less than what General Motors did last year? It's the worst they've done in free cash flow since they filed bankruptcy back in 2009 and went back into business as a traded stock in 2000. Does he not know that? Why is he doing this? Or doesn't he really understand how businesses work? It's like Trent said to me, Dad, the market has nothing to do with fundamentals. It has to do with emotions and momentum. And what the public wants to buy today has nothing to do with fundamentals. I say, Trent, that may be in the past, but that was when we didn't have data and we were lemmings and we just followed the whims of the talking heads on TV and on YouTube. But we have access to the data. I can show you that their return on their liabilities, General Motors, is 2%. They could borrow that same money and put it in treasuries and make 4%. Hell, Ford, they're losing money on their liabilities. They're going down faster than a toilet flush. Okay, I know you say, prove it. All right. That's what we're going to do. And how are we going to do that? We're going to look at the data. We're going to look at the fundamentals. We're not going to pay attention to some stupid statement that says Mary could buy the whole company back in 10 years with $5 billion of free cash flow based on a market cap of $50 billion. Jim! They made $10 billion the year before. It's the worst they've done since they've come out of bankruptcy. The toilet is flushing. Okay, that's my rant. But let me show you. I'm going to take you to and show you how I analyze stocks. How when I hear things like that, I have somewhere to go and say, prove it. Let's look at the data. Let's go to the data. Okay, so this is where I do my analysis of stocks. And as I said, Jim Cramer piqued my interest. I wondered, was he right that General Motors is a real bargain and Ford is too, and that's why he holds them in his charitable remainder trust, and Ford is one of their largest? So I said, I need to get to the bottom of this and come to an understanding. So I basically go in and crunch the numbers. I'll start with Ford here. This is their market cap. And what I look at is their earnings per share going back to 2009. And I compare that to their price, the stock market price, and the movements accordingly, such as in 2010, the price of Ford stock went up 68%, and their earnings per share went up 93%. The following year, it went up 198%. And as you can see, the stock moved right along with it, and Ford was doing extremely well. Well, if I average it out from 2009 through 2023, For every 136% that Ford went up in earnings per share, the price of their stock went up 23%. Well, not so great, meaning that with their projection of a earnings growth in 2025 of 5% and 1.6%, they're only going to go up next to nothing based on that history. But that's not what Jim was talking about. Jim was talking about the amount of free cash flow that they were generating and what a wonderful business they were in. He even went in to say that General Motors had generated, down here you'll see it, free cash flow of $5 billion this last year. And with that, in 10 years, if Mary, the CEO, chose to, she could spend that money, and in 10 years, she'd buy back the entire stock and own it for herself, own it for the company. And it would be a profitable company. But wait a second, Jim. If she'd done it the year before, she could have done it not in 10 years, but in 5 years. In fact, the $5 billion of free cash flow that they had last year that you're touting is the worst they've done since they filed bankruptcy back in 2013. Come on, Jim. What's? I guess the bankruptcy actually was back here in 2010. That's the worst they've done. And you're sitting there telling your viewers that she's doing a phenomenal job? Well, let's look a little deeper. What's her total liabilities? Back here when they came out of bankruptcy, it was $105 billion. It's now $204 billion. So her 5% return on her total liabilities is 2%. Well, come on. She could borrow the money, the 204, and put it in treasuries and do better than that. Could double her. She could make twice as much. And Jim, you're telling your viewers this is a bargain? Look at what your other one, the other one, your one of your largest holdings in your charitable remainder trust, they have a total liabilities of more than that of GM, and they lost $1.5 billion. And look, in 20 years, they could bury this company at that rate. Come on, Jim, be honest with us. Or wait a second, maybe you don't know how to analyze stocks. You don't know how to look at a stock and say, is that good? Is that bad? Is that indifferent? Okay, their net income. How's it doing? Let's look at their revenue. This is the one I love. How is their revenue growing over the years? What is inflation right now? Is it 4, 5, 6%? Their revenues, Ford's, are growing, and they're projecting less than inflation. How do you keep a business alive if your revenues aren't outpacing inflation? Well, how is Ford's or General Motors doing? Well, their revenues were doing pretty good here, 4%, 23%, 10%. Wait a second, projecting in the future, 2, 1. What is inflation? I think it's 4 or 5%. At the grocery store, it's about 25%. How are they staying in business? And how are they staying in business when their liabilities are continuing to grow? It's not all debt. Its liabilities include your accounts payable. Sometimes in these auto industries, they take delivery of parts, and they say, and we'll pay you in 90 days. Well, that's part of this $204 billion that General Motors has on their books, and their return on their debt is $5 billion. That's 2%. Better than General Motors. They're at a negative 1%. So how does that compare to a good company? A company that I would put in my charitable remainder trust if I were being paid $5 million a year to share my knowledge with my viewing audience. What would I put it in? I think I might put it in NVIDIA. It's got a market cap of $2 trillion, and it's got a total liability of $22 trillion. What? What? 204, 273, and 22 return on free cash flow on liabilities? 88%? Wait a second, that can't be right. General Motors is 2. Ford's a -1. And NVIDIA's 88%? Ooh, Jim, you get paid $5 million a year. And I know you believe in NVIDIA, but why would you be talking about Ford and General Motors? I went and I looked up the information on General Motors, and I was stopped. I was stopped in my tracks. I couldn't get any information before 2011. Well, that's because they filed bankruptcy just around then. And it looks like they're on the same path. The next thing I do with my analysis is say, based on the past performance, if I put $10,000 into either of these companies, again, based on their past performance, what am I going to have in the next 2 years? Well, if I put $10,000 in Ford, I'm going to make $36.02. If I put it in General Motors, I'm going to make $24.64. On the other hand, if I put it in NVIDIA, I'm going to more than triple my money. This is fundamentals. This is basically saying, I'm not taking anything you say for fact. I'm not getting tied up in the talking heads on TV, on YouTube, or anything else. I'm going to go to my computer and I'm going to pull the data that is available to me now, was not available to me 5 years ago when I was a financial advisor. Yeah, hell, they didn't know what data was. But it's all been available to Goldman Sachs and their 46,300 employees for managing their $2 trillion. They know this. Now you know it. So, based on that, based on what the talking head that makes $5 million a year and the talking head that doesn't make anywhere near that, which stock do you want to own 3 years from now? Ford, General Motors, or NVIDIA? And I got 37 others that I track that give these, and I've got several that make NVIDIA look sick, anemic. Let's use the word anemic, because they are back here where the growth was possible, where you could have bought this $824 stock for less than $25. They're back here. And I found them. And how do I find them? Because I've studied what NVIDIA has done. I studied what Supermicro has done. And now I found companies that are in the early stages, much as Supermicro and NVIDIA were in the past. I'm picking the long shots. I'm also enforcing and reinforcing my belief in the Magnificent Seven that are going to give me 25 to 35% annual rates of return. But I'm also looking for that Soundhound that's going to give me 1,000% return. Or that Symbotics that's even going to make that look sick. Yeah, it used to be, and Trent is right. It's dead. It's not just the fundamentals. It's the technicals, and it's the movements and emotions of the market. That was true, Trent, when nobody had access to the data, when nobody could take and say, hey, Jim Cramer said that one of his largest holdings is Ford, and General Motors could buy the whole company back in 10 years based on their $5 billion of free cash flow, which, by the way, is half of what it was the preceding year. But he didn't say that, because I don't think he knew it. But now you know it. And we're going to take the emotion out of owning shares of good companies, because we've got access to the data. At least I do. And if you want to share in it, you get on the bus. And you can come to my website, just like Bob. Bob up in upstate New York called me this morning and said, Kerry, on your spreadsheet, back there in my Taiwan Semiconductor, you've made a mistake. And sure enough, I had. Took me about a half hour to figure it out, but I'd made a mistake. I had miscopied something. And now we got it right. So you get it right. Find your way to bestofusinvestors.com. Go up into the header and click on premium and sign up for our premium platform. Costs you $60 a month. But I'll tell you what I just gave you today is worth probably somewhere in the neighborhood of $10,000 today if you don't buy Ford and you don't buy General Motors today or any time in the near future because they're on a death march. Look at this. You could go and borrow $273 billion and put it in a T-bill and do better than lose 1%. Or you could borrow another $204 billion and make more than $5 billion. Why go through all the trouble fighting with the unions, dealing with the government? Just go borrow the money and put it in a T-bill and close the whole thing down. Talk to you again tomorrow.